For years, if you wanted a safe, dependable investment, you bought Canadian bank stocks, right? Strong regulations, steady dividends, a market they practically own. They were seen as pillars of stability. But every cycle challenges what we think we know, and right now, a major structural risk is hiding in plain sight. It's all about the housing market. Canadian banks are incredibly exposed to real estate. We're talking residential mortgages, home equity lines of credit, and commercial property loans. When housing prices were soaring, this was fantastic for them. Property values went up, loan growth exploded, and almost no one was defaulting. It was the perfect environment, but that environment is changing. Housing activity has slowed right down. Prices are falling in many areas and fewer homes are being sold. More importantly, we're starting to see a small but noticeable increase in people missing their mortgage payments. Now, it's not a crisis yet, but credit problems don't start with a bang. They start with a whisper. First, homes become unaffordable. Then, people struggle to refinance their loans. Finally, payments start getting missed. In a market as leveraged as Canada's, even a small rise in these delinquencies can hit bank profits hard. They have to set aside more money for potential losses, their profit margins get squeezed, and their financial cushions get thinner. At the same time, higher interest rates make it more expensive for banks to borrow money, while also putting more financial stress on homeowners. That comfortable buffer from the ultra-low rate era? It's pretty much gone. The market still tends to see Canadian banks as these safe defensive stocks that just pay out dividends no matter what. But if this housing downturn gets worse, these banks might start acting a lot more like volatile, cyclical stocks than the stable giants we're used to. Now, this isn't a prediction of a total collapse. Canadian banks are still very well capitalized and respected worldwide, but cycles matter. When you have high levels of debt meeting falling asset prices, risk gets reevaluated. It happens slowly at first, and then all at once. Rising delinquencies are an early warning sign, and those are the signals you need to pay attention to. In this kind of late cycle environment, it's often more important to avoid having all your eggs in one basket than it is to chase a little extra yield. Protecting your capital is usually a smarter move than just assuming stability will last forever. So, the real question isn't whether Canadian banks are strong. They are. The question is whether the housing cycle has more room to fall, and whether investors are truly prepared for that risk. If you value this kind of disciplined, strategic market analysis and want to stay ahead of the cycle, make sure you subscribe to our channel for more insights. Thanks for watching.